Investors are faced with several different strategies and pathways they can take in order to hopefully grow their portfolio and generate as much wealth as possible through capital gains or even through consistent and growing dividend payments. Dividend investing is a method of buying stocks that pay dividends in order to receive a regular income stream from your investments. This income is in addition to any growth in your portfolio as its stocks or other holdings gain value. Dividends are payments that a corporation makes to its shareholders. When you own the stock that pays dividends, you are getting a share of the company's profits. This allows you to receive a stream of income on top of any growth in your portfolio's market value. For example, suppose you invest in a company that pays a 3% dividend per share. You own one share of the company and shares are worth $100. In that case, you would receive $3 in dividends. How dividend investing works. Buying stocks that pay dividends can reward you over time as long as you make smart buying choices. Some companies may have a dividend reinvestment plan, often called DRIP. With a DRIP, you can choose to reinvest your dividends to buy more shares instead of taking them out as cash. This can be a wise plan when your dividends are small, either because the company is still growing or because you don't own much of the stock. A common question is, are dividends safe? When investing, try to look for dividend safety. This means, how likely is it that the company will keep paying dividends at the same rate or higher? While some companies assess and rank dividend safety, you can also do your own research to learn more. All you have to do is compare earnings to dividend payments. If a company earns $100 million and pays out $90 million in dividends, you'll make more of a profit than what you would if you were only paying $30 million in dividends. On the other hand, if it pays out $90 million in dividends and profits fall by 10%, it won't be able to keep the payment at the same high rate. Lower dividends in turn lower your income. The $30 million payout could also decrease in this case, but by much lower percent. In many cases, companies that pay 60% or less of their earnings as dividends are safer bets because they can be counted on for predictability. Dividend safety is also determined by how risky or new an industry is. Even if a company has a low dividend payout ratio, your dividend payment will likely be less safe if the industry isn't stable. Look for companies that have histories of stable income and cash flow. The more stable the money coming in to cover the dividend, the higher the payout ratio can be. Strategies for dividend investing. A good dividend investor tends to focus on either a high dividend yield approach or a high dividend growth rate strategy, both severe, distinct roles in a portfolio. With a high dividend yield approach, the focus is on slowly growing companies that have high cash flow. This allows them to fund large dividend payments, and it could provide you with an immediate income. If a stock pays a $1 dividend and you can buy the shares for $20, the stock has a 5% yield. And if you were to invest $1 million, you would receive $50,000 in income after a year's worth of dividends. Using the high dividend growth rate, your focus is on buying stocks and companies that pay a lower dividend but are growing quickly. This means that you are buying profitable stocks at a lower rate and making a large amount in income over a 5 or a 10-year period. Different investors may prefer one approach over the other. It all depends on whether your goal is immediate and stable income or whether you prefer long-term growth and profit. When choosing a method, decide what level of risk you prefer. Think about how long you are willing to wait for your dividends to produce your desired level of income. Another common question is, what are the tax benefits? Look for dividends that are deemed to be qualified in order to get some tax benefits. Most income from dividends is taxed as ordinary income, but qualified dividend stocks held for a longer length of time, often 60 days or more, are taxed at a lower capital gains tax rates. If you buy a stock to get the dividend payment, and then you want to sell out of it quickly, you'll have to pay your normal tax rate on that income. Things to watch out for. If you invest through a margin account instead of a cash account, your broker might take shares out of your stock you own and lend them to traders who want to short the stock. These traders who have sold the stock you held without telling you must pay you any dividend that you've missed. That's because you aren't truly holding the stock at the moment. The money comes from their account, as long as they are keeping their short position open. Then you will get a payment equal to what you would have made in actual dividend income. Since the cash is not counted as a dividend, it is treated as ordinary income. Instead of paying a lower tax rate, you have to pay a higher income tax rate. Some key takeaways. Dividend investing is a way to create a steady flow of income. Look for stocks with stable income and cash flow. Choose an approach, high dividend yield or high dividend growth. You can also set yourself up for tax benefits. But before you do any of this, do your research, make sure you understand your investment strategy and the positions you are opening. Hopefully this helped understanding dividend investing, how it works, and the overall investing strategy. Leave your thoughts on dividend investing and like and subscribe for more weekly business and finance content.